All right, Darius, everyone is super excited. They all think all asset prices are going higher, up and to the right. It's so easy. You just put money in the market. You can buy any asset and you're going to make money. Sounds awesome. You, though, may have a couple of different ideas here, so let's get into it. Help us understand how you're evaluating right now. Bullish, bearish, or somewhat neutral?
Yeah, absolutely. So thanks again for having me on. Excellent question. Excellent way to kick off the show. I'll start by answering the question simplistically by saying we are still bullish. If you go to slide one, Matt, one of the things that we do for our investors at all times here at 42 Macro that our clients find quite valuable is to help them understand the full distribution of probable economic and financial market outcomes, irrespective of whether we 42 Macro is bullish or bearish at that particular juncture. We are constantly doing research on the full distribution outcomes so that our clients can have a divergent view of us, or to help them understand how our views might change and evolve in the future. And so, I'll start by saying all of what we do in terms of telling our clients what to do from an asset allocation or portfolio construction standpoint comes through the lens of our systematic processes. These are quantitative processes. They have no bearing on, anything I say about growth, liquidity, inflation, et cetera. And so if you could look at slides 2 and slides 3, slide 2 is our systematic process for retail investors, which shows that we are still fully invested in the context of our KISS portfolio construction process. Recall that's a 60-30-10 trend following strategy with stocks, gold, and Bitcoin. Slide 3 is our discretionary risk management overlay, where we show where we help our buy side clients pick factors long and short across all the various asset classes. And as you can see, we are still in a risk on reflation market regime, and as a function of that, Dr. Mo is still recommending long max positions across pretty much every risk asset. And so that's the starting point for this discussion. And I think it's important to kind of paint that picture in the context of what we show on slide 1 again, which is, the number one thing we do for our clients is helping them identify and position for the market regime.
All right. I want to unpack something you said in there, which is 60-30-10. You said stocks, yep, gold, Bitcoin. Yep. I don't hear bonds. So maybe you can explain why no bonds. I tend to agree, but let's hear your thought process. And then 2 is you got 30% gold, 10% Bitcoin. A lot of people watching this show would say, hey, why don't you do the opposite? Why don't you have 30% Bitcoin, 10% gold? Explain that as well.
Yeah, 100%. Great question. So I'll start by saying the answer to the first question is, we don't think bonds are going to be a great store of value and really a great capital asset for investors over the long term. We see a variety of reasons from a supply perspective why it's very unlikely that bonds, perform as well as other assets on a nominal basis, and certainly are unlikely to perform other assets on a real basis, primarily through our investing during the fourth turning regime analysis. Recall that, we've done a big deep dive empirical study to help investors understand exactly what is likely to happen from the perspective of the economy, policy, and ultimately how policymakers are going to respond to some of these economic developments over the long term. And one of the key takeaways from that study is that we should expect a significant acceleration in the public sector balance sheet over the long term. We've already saw some of it. We're halfway through this fourth turning, so it's kind of right on time, and we're expecting that acceleration to accelerate. The acceleration of public sector growth to accelerate, which will ultimately necessitate accelerated monetary debasement and financial repression by authorities such as the Fed and other central banks around the world in order to sort of, help investors and sort of digest that. So that's step number 1. Number 2 is why 30% gold, why 10% Bitcoin. That's really just a function of our client base. Our client base, on the retail investor side, tend to be more sort of established investors with larger pools of money, generally, speaking, closer to retirement or even some in retirement than the sort of, I would say, the average person probably watching our discussion right now, which is probably someone who's a millennial or Gen Z investor with no offense, but a lot less money to manage and a lot less stuff to worry about if you think about, planning for their children's financial future, planning for retirement. You can't have, more my opinion. It's my opinion as a, institutional risk manager, you don't want to have 30% of your portfolio indexed to a asset that has a 50 to 75 vol. It's just not a smart way to live life from the perspective of your health and your financial health, but it is what it is. But obviously 10% is plenty big enough.
That makes sense. So let's go to slide 4 here. You're talking about dollar strength, which I think a lot of people, when they look at gold or Bitcoin, they've been saying to themselves, well, if those win, then the dollar has to lose. Actually, maybe what we're seeing here is like dollar, gold, and Bitcoin all are going to win in the future. And so describe what you guys are looking at here from a kind of analysis standpoint.
Yeah, so I'll start by saying, dollar strength tends to suck liquidity out of the global financial system, which is what we're talking here on slide 4. And the reason for that is, historically speaking, dollar strength and dollar strength tends to be causal to currency volatility, and currency volatility tends to be causal to drawdowns in broader global liquidity. So investors need to be aware of that. If we continue to see dollar strength in the context of the repricing of U.S. exceptionalism, as well as the impact of tariffs, not to, in terms of shrinking our trade deficit, and more importantly, causing our trading partners to depreciate their currencies relative to the dollar, you could eventually get to a place where we're crossing some critical thresholds as it relates to the supply and availability of dollar financing globally. We show on slide 5. The reason dollar strength tends to suck liquidity out of the financial system is because the dollar is the most important currency in the global financial system. We kind of need a weak dollar, generally speaking, to have a good global economy and good global financial markets. Dollar is 60% of global FX reserves, 60% of global cross-border bank lending. It's 70% of international bond market. The international bond market, it's 79% of the global trade invoicing, and 88% of foreign exchange transactions, and 99% of stablecoin backing. So generally speaking, if the global financial system is set up, for the to use the dollar in these various forms and fashions, then we ultimately kind of need a weak dollar to improve the supply of dollar available, the available dollar capital to keep the global liquidity rising. And so that's kind of one of the things we're very concerned about in the context of where we are in the positioning cycle. That's one of the slides we don't have in this presentation today, but our positioning model is essentially saying we're probably in inning 8 or inning 9 of this raging bull market. And so, you use that as a starting point from the perspective of our econometric process. If that's the starting point for any discussion, we have to start to look around the corner at things that might cause, the raging bull markets that we're all participating in. Recall that we are fully invested and have been for most of the year. At some point, this raging bull market's going to end, and we have to start, anticipating things that might cause it to.
Now, if it does end, I think there's a lot of people who are saying, yes, but the central bank has immense amount of tools. They got a lot of interest rates that they can cut. They got a lot of money they can print. Have we actually outlawed bear markets or recessions because the Fed is so willing to step in so aggressively and kind of right those downturns? Or do you still think that, investors need to be prepared for these market downturns? Because even if the Fed steps in, they may not be able to actually kind of mute them.
Yeah, well, look, I've been doing this for 15 going on 16 years now as an institutional risk manager on Global Wall Street, and I've yet to see an instance where the Fed was proactive. Right, the Fed is a reactive government agency that uses lagging economic indicators to take action. Right, so that almost guarantees that there will be times in the future. Obviously we've seen plenty of these instances in the past, but there will be times in the future whereby the markets are demanding accelerated monetary debasement, accelerated financial repression from institutions like the Federal Reserve, but they're not getting it yet. And the not getting it yet part is the part where S&P's down 20, Bitcoin's down 50 to 75%, and gold's down 20% as well. That's the risk that you have to be aware of as an investor in the context of what should be a multi-year trend of a Federal Reserve balance sheet that continues to expand rapidly alongside the growth of the U.S. public sector balance sheet.
And let's go to this international investment deficit. You're saying that it's doubled. What does that mean?
Yeah, so this is something I think is important to remind investors of. Here's why dollar strength could potentially cause some problems. And there's a couple of slides here on this. Well, so I'll start by saying the U.S. international investment deficit on slide 6 has doubled in the 5 years through December 2023. That essentially means that the amount of assets, financial assets that foreign investors own in the U.S. economy are, doubled from $10 trillion in late 2018 to $20 trillion in 2023. It doubled. Again, the U.S. has been around since the 1700s. Our net international investment deficit doubled in 5 years on an economy that's been around for almost 250 years. So that's how much foreign capital has flooded into U.S. financial markets in recent years. And so we have to be cognizant of this as investors, that if the dollar gets too strong, which is something we show on slide 7, if the dollar gets too strong, foreign investors will be forced to repatriate, U.S. dollar assets, in order to preserve their ability to service that, 79% of global, 70% of global international debt markets that is U.S. dollar backed, and the 60% of global cross-border lending that is U.S. dollar backed. So that's an issue. On slide 7, we show what happened in 2022 when we had, a significant uptrend in the dollar that caused, some of these conditions that we're talking about. Dollar was up. If you look at, the performance of the dollar from, the beginning of January of 2022 through September of 2022, dollar was up 18%. Commodities are up 15%. And those two things caused a significant reduction in liquidity that caused gold to be down 10% through September of 2022, caused U.S. equities to be down 25% through September of 2022, caused U.S. bond market to be down 31% through September of 2022, and it caused Bitcoin to be down 58% from the start of the year to September. I think it was down 75% peak to trough from the peak in November of 2021. So the key takeaway here is that we have some policies developing from the perspective of the Trump administration, not the least of which is the tariff policy, but we also have a potential change in net financing policy by the Treasury. Both of those things could cause, accelerated dollar strength on top of what is likely to be, extension of U.S. exceptionalism vis-a-vis tax cuts, deregulation, et cetera. So eventually this will all become an issue for asset markets if the Fed is unable by, as a function of resiliency of the economy or the stickiness of inflation to prevent the dollar from, trending higher in an uninterrupted fashion.
Now, if we keep going through this, what is this showing us on this next slide?
This the global refinancing air pocket?
Correct.
Yeah, this is probably the scariest chart in all of global macro. And
I just see a lot of red, and that scares me. So immediately I'm like, "What's up?"
Yeah, no, I got my crayons right on this one. So, I use red for a reason when I created this chart because to me, our friend Raoul Paul is one of the smartest global macro minds in the world. Huge fan of mine, or a huge fan of his. And I consider him to be a mentor of mine. He sort of created this framework called the Everything Framework that essentially identifies that, the number one factor that you need to get right for predicting, significant inflections and trends in the global liquidity cycle is the lagged growth of global financial sector debt. Piggybacking on his research, we did a big deep dive study with hundreds of economic time series to, one, confirm whether or not what Raul was saying was true, which it turns out to be true, and two, to confirm, okay, are there any other indicators that lead global liquidity from a multi-quarter and multi-year perspective? And the key takeaway from our analysis is, again, this is a deep dive empirical study with hundreds of time series. What Raul is saying is true. It is true. The global refinancing cycle is the leading indicator for global liquidity. Specifically in this chart on slide 8, we show the world total non-financial sector debt growth, the year-over-year rate of change of that growth lagged 4.5 years to kind of account for, kind of the typical amount of time that passes between, when a piece of debt is issued and it needs to be refinanced, just kind of the general duration for most, global sovereign debt, global debt instruments, somewhere around kind of 5 to 6 years. So 4.5 years is kind of when the beginning of that refinancing takes place. And so what you find is that, okay, there's a really tight fit between this on a lagged 4.5 year basis relative to the fluctuations and trends in the growth rate of global liquidity. And so you have to be concerned as an investor, looking at the chart where the question marks are, there is a significant acceleration in the lagged growth rate of global non-financial sector debt on the precipice, kind of all the way through late 2020, from now all the way through late 2025. And so the issue is, the rose-colored glasses or the Pollyannish view of this would be, okay, we're going to get a significant acceleration of global liquidity. But the issue is that we may not get a significant acceleration in global liquidity. If we do not get a significant acceleration in global liquidity, we're going to have a complete meltdown in global financial markets, just like what we saw with all the other boxes. The first red box is the global financial crisis, where global liquidity was moving in the wrong direction of the lagged growth rate of global financial sector debt. The second red box is the summer of 2011, which obviously it was a significant drawdown in asset markets. The third box was this summer of 2015 leading into the beginning of 2016. We had a couple of back-to-back, 15 to 18% declines in the S&P 500. And then we had 2018, the Q4 18, we had a significant drawdown in the S&P 500 and all other risk assets. And then we had one in 2022. So, the risk to the upside is that the blue line chases the red line higher over the next 3 to 4 quarters, which, I believe Raul and other analysts are, have caught on to this kind of line of thinking are forecasting. The risk, according to what we, based on where we are in the positioning cycle, the risk that I'm putting my macro risk manager hat on, which is my primary job description, putting my risk manager hat on is, okay, what if the blue line does not catch up to where the red line is saying it needs to catch up to avoid this global refinancing air pocket? And that's, to me, is the big risk for 2025.
Now, when you look at this, you've got this chart here that's showing the risk-off market regime. Why is it that this global refinancing air pocket causes that? Today's episode is brought to you by Meanwhile. Meanwhile is the world's first licensed and regulated life insurance company built for the Bitcoin economy. Operating on the Bitcoin standard, they do everything in Bitcoin. You pay in Bitcoin. They pay claims to your family in Bitcoin. You take out policy loans entirely in Bitcoin when you need liquidity. Meanwhile, Bitcoin life insurance has redefined what it means to hodl. Protect your family from life's uncertainty in a broken financial system. Build intergenerational Bitcoin wealth while the cost of living skyrockets in dollar terms. Get all the tax and legal benefits of life insurance now in Bitcoin. They are actively binding policies today. Whether you are a long-term Bitcoiner or are just considering it for the first time, a Bitcoin whole life policy could make sense for your wealth plan. Visit their website, meanwhile.bm, to join the waitlist and to learn more about the world's first Bitcoin life insurer. Again, that's meanwhile.bm. Go check them out today.
Yeah, because what happens, the reason the global refinancing air pocket, so what a global refinancing air pocket is when those red boxes in the previous chart, right? If the blue line does not meet the needs of the red line, you have a refinancing air pocket. And the reason refinancing air pockets cause trending risk off market regimes is because the global private sector, the global investor class needs to create balance sheet space in order to get the rolls on those refinancings. Right. So what ultimately happens is you typically need to see the ex ante return across capital markets wide rise. So the only way you have ex ante returns rise is you have valuations come down, you have credit spreads rise, you have the yields on those credit instruments rise. And so that ultimately means is, it creates more attractive conditions from the perspective of creditors who don't necessarily have enough balance sheet space to roll those debt burdens anyway. So they need to create the balance sheet space. And the only way to get them to create the balance sheet space is to create, higher ex ante yields. And so that's what this chart shows, is that every time we've had a significant drawdown in risk assets, including Bitcoin and other crypto assets since the global financial crisis, it has occurred in the context of a global refinancing air pocket as determined by a drawdown in the growth rate, a drawdown in total global non-financial sector debt. And typically those refinancing air pockets coincide with a drawdown in global liquidity. So this is, again, it's not a forecast, but it's me sort of doing the early work on following the bouncing ball where asset markets might be this time next year, right? It's not it's one thing to say, okay, all of our systems are ragingly bullish as they currently are with KISS and Dr. Mo, but my job in terms of peeking around the corner, specifically for our institutional clients who may not be following our systems as religiously as our retail investor clients, I got to peek around the corner and start thinking about these risks. And to me, if we're having this conversation 12 months from now, and the S&P 500's in like the high 4,000s and Bitcoin's in the 50,000s, then we got to, this will be the reason why.
Now, the United States of America, you think, will play an outsized role in this scenario?
Yeah. So to me, it's the growth of the U.S. public sector balance sheet is most causal to the lack of balance sheet capacity globally. And this is, this is something, in our opinion, this is going to be a real feature of the economy and asset markets for an extended period of time, which is why we are so structurally and fundamentally bullish. We understand that the Federal Reserve is the only institution in the world that can offset that. And they will be forced to offset that, just like they were in the previous foreturning, going back to the 1940s, about the yield curve control we saw in the 1940s and persistent financial repression and monetary debasement we saw throughout. And we're observing it already, but I think we're going to continue to observe it in greater and greater degrees. But going back to kind of the root cause of the problem, the reason why the Federal Reserve is the only institution in the world that can keep pace with this, these financing needs from the U.S. government, is because these numbers are just getting ridiculous. So the chart on the left here on slide 10 shows the approximate next 12-month marketable treasury debt supply and then its impact on the interest expense. And so how do we determine the marketable treasury debt supply? That's the chart on the right. And so we determine what the marketable treasury debt, federal debt maturing over the next 12 months is. So we have that at around just a little over $9 trillion. And then we annualize the fiscal year to date budget deficit. That's a little over $3 trillion. That number's a little bit too high. It's probably going to be closer to 2 trillion, but it is what it is, only 1 month of data. And then we have the annualized rate of divestment from the Fed's treasury portfolio. So this is the kind of total amount of, gross supply that's going to be hitting the market from the perspective of, the kind of the three main conduits where treasury supply comes from. And so we add all that up, you kind of wind up with a $12.5 trillion number from today's starting point over the next 12 months of the amount of gross treasury supply that's going to be hitting the market from these three conduits. Now, again, 12.5 is a little bit high. I'm guessing it's going to be somewhere closer to 11.5, just based on the annualized fiscal year to date budget deficit probably coming in somewhere closer to 2 trillion by the time it's all said and done. But again, $11.5 trillion of gross debt supply is a significant number that could cause a lot of indigestion in asset markets, to the extent that those ex-ante yields haven't been raised prior to this process. And then the chart on the red line and the chart on the left just shows the approximate nominal change in the interest expense due to this debt refinancing. So if you refinance, $12 trillion of debt from the current, the current weighted average interest rate on the Treasury's portfolio into the average market rate across the entire Treasury curve, you're talking about taking on an additional $100+ billion of interest expense. Right now, interest expense is already $1 trillion, and it's tied for the third largest share of federal expenditures. We're going to go from the third largest share to definitely the second largest share by the end of this process. I really don't see how you stop this process unless you have significant deficit reduction, which in our view, the most populist president since FDR is probably not going to take a big chainsaw and weed whacker to the federal expenditures, at least not without force.
So DOGE, Department of Government Efficiency, they claim that they are going to cut costs. They are going to fire all these employees. They're going to clean all this stuff up. Do you believe them?
No. I believe that they're going to try. I just don't believe that they're going to be very successful. So let me start by saying, when you start looking at the various pockets of U.S. government expenditures, if you think about the things that are definitely not going to be cut, it's about 61% of total federal government expenditures. It's interest expense. Obviously, they can't choose to cut that at all. It's Medicare and Social Security. These are the two entitlement programs. In our opinion, we don't think they're going to cut that at all. And then you have total national defense. In our view, none of those three things are going to get cut. None of those four things are going to get cut. And then when we, taking our own secondary analysis, when we layer on things like veterans benefits, we layer on things like Medicaid, and we layer on things like welfare, I just don't see how, again, the most populist president since FDR is going to come in with the national mandate to basically slash all the programs that benefit the people that are his base. His base are poor people, more specifically poor white people in the middle of America. That's his base. And so I don't see a very high probability of a significant, DOGE being able to enact significant cuts to these programs. And so if you add all those things up, like interest expense, Medicaid, Medicare, Social Security, national defense, the interest, veterans benefits and services, you're talking about 90% of the federal government budget, a little bit over, kind of roughly around $6.2 trillion. The other 10% of the federal government budget is roughly $700 billion. If they cut every other thing the U.S. federal government did to zero, it'd be roughly around $700 billion, about 2% of GDP of savings. So you're talking about going from 6% of GDP budget deficit to 4% of GDP if they literally cut everything the government did besides those 7 categories that I highlighted. So I just don't see DOGE being particularly successful at their mission. But ultimately, the markets are going to, I think the market's going to give them a pass until they find out they're going to be unsuccessful with the mission. So at the margins, that, reduces volatility in the bond market from the perspective of return premium. But eventually, this is going to be something that we're going to have to deal with as investors, probably at the worst possible time in the context of that global refinancing air pocket that may be developing.
My favorite thing that they've said so far is just, we're going to make all the employees work 5 days a week in the office. And like half of them are going to quit anyways, because they don't want to do that.
Agreed. No, again, like I said, they're going to cut a lot of stuff. I think they will be successful cutting hundreds of billions of dollars from the federal government expenditures. I just don't see how, when you start cutting programs that the most populist president since FDR is essentially promising to his base, his very loyal base, I just don't see how that's going to cause, going to go over well. I think it's more likely that Elon and Vivek Ramaswamy and to some degree Scott Bessent get fired before these programs get materially cut. I think that's more likely. And ultimately, that could be something that takes us one step further to a U.S. fiscal crisis and loss of dollar hegemony. But again, we got to follow the bouncing ball on this stuff. We're talking about, market dynamics and policy dynamics that could be, multiple years away.
It's fascinating to kind of think through this stuff right now. Thank you so much for putting these charts together. I learned something, which is always a good sign. Where can we send people to find 42 Macro or find you on the internet?
Oh, I appreciate you, man. Oh, it was a pleasure. So yeah, definitely come check us out. We're 42macro.com. I'm Darius Dale 42 on Twitter. Like I said, when I started this conversation, a lot of what we do at 42 Macro, so let me start by saying, we don't do what I think you guys do. You think we do at 42 Macro, which is think about all this stuff and then construct portfolios as a function of all this stuff. None of what I just said for the past, half an hour prior to the first or after the first 3 slides has any bearing on our clients' portfolios. The only stuff that has bearing on our clients' portfolios are our systematic KISS portfolio construction process, and our systematic discretionary risk management overlay process. If we're right on our fundamental views, then our systematic processes will trend follow us into the appropriate solutions from a portfolio construction and asset allocation perspective. And if we're wrong on our fundamental views, then our systematic processes will manage risk appropriately. And so that's, we found that to be the best way to invest. That's what all the world's best hedge funds are doing, by the way. So wink, wink, nod, nod. If you're not investing like that, you should probably start. So 42macro.com. Come check us out.
Thank you very much. And we'll talk again next month.
Appreciate you, brother. It's great to see you, man. Happy holidays.